We are here. Welcome to Momentum Mondays. This is Monday, March 3rd, 2025. And we're going to do another podcast where we go into some insights into the stock market and look at the week ahead and look at market performance and what's up for the week ahead. But I already said that. So I'm going to throw it to you for the disclosures. And remember, we're on audio, so slow it down. Not too slow, but just go ahead.
Okay, yes. Before we dive in, just a reminder, all information shared during this podcast is for educational purposes only and should not be considered as financial advice. Always consult with a financial advisor you trust before making any investment decisions.
That sounds great. Very good job.
I think so.
Much improved over last week. Anyway, let's look at the market performance. Boy, what a week last week, huh? The markets. Week of 224. We had the S&P down 0.96. NASDAQ down 3.4%. Really took it on the chin last week. Dow Jones was actually up last week, almost 1%. And then the Russell 2000 down 1.45. We had a lot of activity last week. And then on Friday, everything kind of rallied. And then I got an alert on my phone today. We're recording this morning. There's an alert on my phone from Yahoo Finance that the markets were poised to open up today. And Look at the markets and they're down. So, this is the whole cyclical thing that we talked about last week. It does kind of tend to go into March a little bit. But typically what you have in a season where you are first quarter after a new president is elected, you generally have a bottom sometime in March. So that's what we would look to see. If we're looking at commodities, we're talking about gold down 2.76, silver down 4.33. Those, had been the high performers for the year, and they got just clobbered. 1-year bond up 1.72%. And I just want to, because of the conversation we had last week with the 10-year bond and how important it is, these are bond prices that we're talking about when we give these performance numbers. These are not the actual yields of the bonds.
Correct.
So the yield of the 10-year was actually down last week, over 2%, I think.
Which is, if you're listening for some time, you'll hear us always talk about, we want to see the yield, the interest rate on the 10-year treasury go down.
Right.
Okay? So when we see that prices of the bonds have gone up, it's the exact same thing. It's moving in the direction that we want. So we want the prices of fixed income securities to go up, which means the interest rates have gone down. And we can always, recap that for anyone that's, listening that would want to know why we want interest rates to go down. Very simply put, lower interest rates, better for the consumer. We have more discretionary spending power that way. Also, mortgage rates go lower. Generally, risk assets go up.
It's because it's the thing that everything's tied to. It's the benchmark for most rates.
And let's real quick, before we go further, since you hit on the market last week. And the
Let me just finish the commodities section, because Bitcoin is the biggest one, down 12%.
I thought you'd already mentioned Bitcoin.
3%. No.
I'm just tuning it out.
So, down. It had a really rough week last week for Bitcoin. So go ahead. Sorry. Down 12%. Then after you're finished, we'll take a look at how that affects the year to date, because we have been looking at that over the past few weeks.
So, if you've listened to, 3, 4, 5 of our podcast, the how we pick up on kind of the seasonal, the predicting kind of what's happening in the market based on seasonal things, seasonal weakness, seasonal strength. And one would, ask, well, why don't you trade on that? Well, it's one thing to have a general assumption that we're going to experience strength or weakness during a given point in time. It's difficult to trade on that because you have to be off, let's say there's a 20-day period of either weakness or strength. And if you're off one of those trading days, you're up the creek. So we don't trade around seasonal strength or weakness. We use our momentum indicators to build, a high degree of confidence in the short, mid, and long term as to which asset classes we should be in, and that includes cash, because that is an asset class. But it's interesting to look at the seasonality of the market. But, in general, it's not something to place your trading decisions on. So if you hear us talking about weakness, that doesn't mean hit the sell button, because the weakness could be from 10:30 Eastern to 2 p.m. Eastern had a bout of weakness that was pretty significant. And by the time you place your trade at 3,
yeah,
it may not be anything to trade on. So you don't,
this will generally come out when the market's closed.
Well, I guess it'd be the next day, right? Today could be the weakness, and then tomorrow we could get the rebound.
But we only have one model that we use, calendar-based trading on, and it's really our kind of fail-safe in case of emergency break glass type situation. We used it a lot during 2022, which is when the market was really not great. We weren't holding bonds. We were holding a lot of cash, but we had periods of time during that year where we would go in for a week to 2 week periods.
And that is called our
calendar effects model. Yeah.
And that is using the best trading days, regardless of bull bear indicators, regardless of
that's historically
weak momentum.
That's right. That's periods of time where we have seen that the market is historically profitable. And so it's about 11 periods during the year. Just about 72 to 75 market days of exposure. So that's sort of a super conservative model.
And it's a great hedge against just having everything in cash when there's weakness in a bear market. Because you can still, historically speaking, calendar effects makes 8% on average if used purely by itself.
Well, I was looking at that this morning. Today, year to date, it's up 2%. And so if we look at, it's a good segue into the year to date, S&P is only up 1.3. Now, this is a moment in time. So this is a very conservative strategy, and it just happens to be working right here in this bout of volatility where you had the market swing this much. But year-to-date returns, we look at the S&P, we're up 1.38. NASDAQ is actually down on the year now, 0.60. Dow Jones is actually up 3.22. And the Russell 2000 is down 2.86. Russell 2000 is still lagging there, which is not something we want to see. We've talked a lot about it, so I don't want to go on ad nauseum about the Russell 2000. We probably should
stop talking about it. And
maybe so. Maybe if we forget about it, maybe it'll start moving. But that is one thing. Well, that is for us and for me in particular, because I look at this a lot. But for me, that is one of the areas that I continue to look at is the Russell 2000, and the fact that it is still not. How long have we been talking about the Russell 2000
Summer
making moves?
Last year.
So it is still not keeping up with the other indexes, which to me, going back to the breadth conversation, BERADTH. Did I spell it right? BREADTH. Yeah, we'll try that again. Speaking about that conversation, that's when sort of the market overall participates in a rising market environment. And the Russell 2000 has had a few bouts of that, but it overall has not kept up. And that is a concerning thing. I'm not going to lie. We feel pretty good about where the market's headed this year. But that is one kind of thing that's ringing in the back of my head about the Russell 2000. About it has to keep up.
It could be concerning, or it could also tell us that the bull market really hasn't taken off.
Yeah, somewhat. I mean, you had something similar happen in the early 70s with those indexes sort of becoming disparate, and that was not a lead up to many great things, unfortunately. So that's just one of the things that you kind of keep in mind. We're not seeing that. That's not alarm bells or anything.
It's not being borne out in the data.
Right. But it is an area that we're watching with great interest. Year to date, look at gold, 8.73. Silver up 7.5. So now we have here, gold has actually overtaken silver year to date, whereas last week silver was up 11 or 12%.
That could also
this conversation or the week before
be indicative of weakness in the industrial sector potentially. Silver is an industrial metal. It's not a monetary asset. No matter how many TV commercials you see wanting you to buy silver in your IRA, it's driven.
Your self-directed IRA.
Yes, it's driven primarily by industrial demand. So that could be it as well. I still think I would have thought differently had the Russell 2000 maintained its upward trajectory from summer to the end of last year, but it really didn't. It went up summer to August, and then from there it did deteriorate. So, but I would think now, and I'm holding to the belief, which is all that it is. It's not something you trade on, but that we're not going to see the Russell 2000 really take off until we see what happens with the tax bills, the tax renewals. I really think possible. That. The trade stuff, less so. I don't think. But
the Russell 2000 a lot of times is talking about seasonality and cyclicality. It's very seasonal and it's very cyclical, and so that's why you had even fund advisors or fund managers last year in the summer talking about the Russell 2000 going to be up 40% by the end of the summer. I mean, this is something that traders and analysts pretty much expect to happen with the Russell 2000, is that they have strength toward the end of the year and the beginning of the new year. And we're just not seeing that. Now, we're still in the early times of the new year. So I don't know. It's yet to be told. We don't have enough information to really have great commentary on it, but it is an area that we're looking at. Obviously, we've been looking at it for a long time. It's a laggard, and it's kind of concerning that it's a laggard. So we want to keep watching it. 10-year bond up 3.43. Again, this is the price, which means the yield is down on the year, and we're seeing that reflected in some things we'll talk about in a minute. Bitcoin up 1.76. So we had a 12% drop in Bitcoin last week. We're still up almost 2% on the year. So that is, the volatility of that sector, and, sort of to be expected. But an interesting thing that I did see, because we can track flows of buys and sells into certain positions and holdings. And specifically now that Bitcoin is an ETF, we can track the flows into it and out of it. And most of the people that were selling were people who had just bought in. These are people who maybe hear on the news Bitcoin, or see somebody talking about it in a grocery store or something. They go on their Robinhood app or their whatever, and they buy the iShares Bitcoin fund or the Grayscale Bitcoin fund. And then they see, a 12% drop, and they get scared and they sell it. So this is not, the majority of the holders of these ETFs. There's still a lot of money going into these ETFs, and there's still people holding it. So it was a lot of shaking out of what we would call weak hands, I guess. Is that what we would say?
Yeah, it is. It's people that don't understand the asset, especially if you're using leverage as a newbie in the space. It'll eat your lunch. It's a very volatile asset, but volatility over time, as adoption increases, will go down. You have money managers such as ourselves that are allocating anywhere between 6 to 10%. If you really understand the asset, you're going 6 to 10%. If you're, one of these big box advisors that's finally been given permission to do it, you'll do it at 1% just to say that you do it because you're scared. They say scared money never makes money. But, if you understand the asset, you're most likely between 6 to 10% in your portfolios, and that's going to be a fairly constant. There'll be some decrease or increase in that based on the cycle we're in. But just looking at the most recent BlackRock study that was conducted on the impact of portfolios that had around a 10% allocation of Bitcoin, and the alpha generated from that, even during Bitcoin bear markets, is significant. It's significant. The annualized rate of return from Bitcoin on average is 100% a year. Now, you're going to have 2 years or you're going to have 1 year that is an 80% drawdown. But even when you calculate that into it, still averages out. So that's why you want to have a decent allocation to it. You want to be very tactical in, as a money manager, when you decide to deploy capital to Bitcoin. If we were just flipping on the switch, we've been in Bitcoin for a long time, but if we were just flipping on the switch at 100K, we already know that if we're in at 100K, the top's probably 160 to 180 this cycle. So that means we have 60 to 80% gains, which is good. But, when we were in Bitcoin at 30,000, we knew we had 600% to go. Right?
What's the price of Bitcoin right now?
92.
Okay. So for context here, 92 is where we were at the beginning of January-ish.
Yeah.
So, this is...
But it's time to sell. Yeah. It's time to sell.
It's funny how it works, is because you're on the way up and you're making money, and then you have something that kind of comes in and corrects everything, and kind of the washing out, so to speak, and the opportunity for some rebalances, which is what volatility is, if we're honest. And if we're in a market where we feel is a secular bull market and the trend is up, every piece of volatility, we talk to clients about this all the time, is an opportunity for a rebalance. And so you had a lot of things in the news over the weekend regarding Bitcoin, with the Trump administration looking at a strategic Bitcoin reserve.
Well, see, that's not new to me. They said they were going to do that. And I don't get this. Like, everybody jumps up and down, he saved they already said they were going to do it. So
but Bitcoin was like an afterthought, because he didn't even include it in the initial whatever he did. Was it a tweet or a truth or whatever he's calling it?
I don't know, but I also don't expect, with all due respect to our 80-year-olds, I don't expect, when it comes to tariffs, I'm pretty sure he knows exactly what he wants to do and when he wants to do it because he's been talking about that for 60 years or whatever. But when it comes to Bitcoin, it's like, I'm sure it's whoever,
right.
else is in the administration. Yeah. And it's like
David Sachs, which he divested all of his crypto holdings before Trump took office. I didn't realize that.
He's a good man.
He's got some publications coming after him for that, and he's about to release all of his financials. But I saw his tweet out the other day saying, no, I sold that.
Oh, he's already rich as Croesus anyway, so it doesn't matter if he misses out on the run-up. But that is an ethical thing to do.
Well, that was a big thing, though, as having him a part of the administration and the other guys like Howard Lutnick and Scott Bessent. These guys are crypto guys. They understand the asset class, and they are involved in it in some aspects. Now, there's some argument to if Sachs is involved indirectly via, companies that he manages or anything like that. I don't know. We'll have to wait to see that. But the more interesting thing about that was not that they were announcing a Bitcoin strategic reserve. The more interesting thing is that he's going to include some of the smaller altcoins like XRP and ADA and
anything American-based.
How I feel about that, to be honest.
Well, American-based altcoins. Well, if you want to...
just what we were talking about with the volatility, with Bitcoin itself and Ethereum, really. Ethereum is even more than Bitcoin in the volatility conversation. But then you have altcoins, which is like a whole separate universe, which they are on a wild ride. So maybe if you have them at a lower exposure, maybe it makes some sense. But we've already seen people try this with Wisdom Tree a few years ago. They came out with a crypto index that was built upon holding, Bitcoin and Ethereum at these larger weights, and then some of your altcoins at a smaller weight. And then some of those altcoins, they're not even around anymore. So it's a hard thing to do if you're looking at it from that respect. I think.
Well, most of the ones that I've seen that would qualify for being held have been around for a long time. It's either DeFi, which is
decentralized finance,
then DePIN, which is
decentralized pennies. I don't know.
It's decentralized physical infrastructure.
Okay.
Then you have smart contracts. DePIN.
Yeah. DePIN. Why do they add the N?
I think what's IN infrastructure. I guess I didn't come up with it. That's what it is. I was not aware of this for a while.
DeFi and DePi.
DePi, decentralized physical infrastructure. I don't know. They went with DePIN.
Yeah. Well, I don't know. Something new every day.
Yeah. There you go. And then you have smart contracts, which are self-executing software. It's trustless. You don't have to have a central party. And if they've been around for a while, you want the U.S. to have some control over, because a lot of these projects have placed their foundations in foreign countries such as Switzerland, South Korea, Singapore, and it's because they were scared to death of U.S. regulators. So if they can improve the regulation and make it more accepting, then those projects are going to get more liquidity and more use in the U.S., not less. So I think that simply by saying, hey, we're going to put, if we have this strategic reserve, we're going to put 1% into the Helium network, or 1% into ADA, Cardano, 1% into...
but I feel like it's an uphill battle
Litecoin.
to do that. Like, if you're going to announce the strategic reserve, maybe phase 1 is like Bitcoin and Ethereum. And then maybe phase 2 or phase 3 is like trickling in a little bit more exposure based on like some sort of brand awareness campaign or something about these. A lot of people are familiar with, I don't know what people are familiar with. We're so in this that I don't know what regular people are familiar with. XRP, I would maybe assume that people are, but that's even going through a lot of some, what do you call it? There's some, my mind just went blank. There's some argument about that, or some
centralized versus not centralized.
That's right. There's some stuff going on about that. Cardano, that is an old type. That's a kind of a stalwart that's been in a while. I think I've got some Cardano somewhere in some wallet. I don't know.
Don't lose your passphrase.
I think I've also got some XRP actually.
It's all very interesting. I think that if your goal is to increase America's dominance or to make America dominant in the crypto space, you have to do more than just Bitcoin.
Yeah, but you have to, in order for it to make sense to people, and that's a hard conversation because as I'm going through it in my mind, the way that you generally get the population on board with an idea from an administration is generally via reporters and the news cycles, which has to be turned on its head because that's not the case anymore. I mean, we've gone through years of them just bald-faced lying to the American public, and their trust is at all-time lows. So you don't even have that benefit anymore. Now, Trump owns the social network, the Truth social network. Elon Musk is obviously a part of the administration, so they can do certain things via the internet, but you still have a subsection of the population who is not going to get their news and information from there. I don't really know where they get their news and information from, and I don't know how you disseminate that information.
Reddit and Facebook.
So I don't know how you disseminate that information. And then you have the thing that we talked about last week, which is that all of these scams that happen on Facebook in particular. We get comments all of the time on YouTube too, because I'm now that we're uploading to YouTube, we have to go in and regulate these comments that we're getting, and they're all crypto scams. They absolutely could put a stop to that. There's no reason why they can't. These are all basic boilerplate comments. They're formatted the exact same. They could go in and use syntax and large language model and learning, AI stuff to go in and snip these things out. But instead, they put that on the creators to go in and, watch the comments for these things that could lead to some sort of scam.
I think it's a nefarious purpose. I think they're doing it. They're still allowing it to happen because there are people in leadership at these large organizations that still have such an anti-Trump bias that because now he's pro-crypto, they would do anything to erode the public's trust in crypto. I still think that's a large part of it.
I mean, Google maybe, Facebook certainly not. Zuckerberg has had like a complete 180.
Maybe he's not aware of it. I don't know, but I do know what you're saying. Between 2021 and 2024, you say anything on a YouTube video about the Russia-Ukraine war or about the 2020 election or about the vaccine, that comment would get deleted.
Yeah, I mean, it's purposeful
within a millisecond. So yeah,
you may be right. It's purposeful at this point, but that's not the image that he's putting forth. So that's the only thing that I would say.
Unless the people that are moderating it have these crypto wallets and they're in cahoots with the scammers. I mean, who knows?
Yeah, I don't know.
Don't do anything with crypto, Facebook and YouTube. Just stop. Don't do it.
And don't go to a gas station with a Bitcoin machine in it and put any money in that Bitcoin machine. Don't do it.
Don't do it.
But what I'm saying is that there are subsections of the crypto space, namely Bitcoin and Ethereum, that have the wind at their back. So if we're going to announce a strategic reserve, let's focus on those two. And then maybe we create a campaign in the administration to support these American-made companies that are doing stuff in this space that are interesting. But we use that to sort of prop them up, or we use that to sort of say, hey, look what Bitcoin's done, look what these guys are doing, and there has to be a campaign of explaining it. Otherwise, all the altcoins that just get crapped on constantly, some for good reasons, we have to have a way to separate those.
Yeah, but that's assuming that we're smart enough to know which one should and should not be separated. And if you think about, was it the role of government
I think
benefit one asset versus the other?
Well, I think that to a certain extent you can do that. I mean, to a certain extent you can read the documentation about these coins. All these guys that are making these coins, or celebrities that have these coins that get released.
Yeah, but I don't think they're not talking about meme coins. I mean, what
I'm saying
list that
is that
hasn't been.
No, they're not. But what I'm saying is, to the public at large, there's no difference in those, because we hear constantly Bitcoin and Ethereum. We don't hear constantly XRP or Cardano or Polkadot or any number of these.
If someone's listening to this, they had no idea about anything with crypto and they're hearing the words Polkadot.
That's what I'm saying. This is a perfect example. This is proving my point exactly. This is exactly what it is. And so there has to be like some source of information that they can get. And that's a hard thing to do. I don't know how you do it.
No, it's a great point.
Maybe the idea, which is like everything else in the Trump administration, you just ram it down and see if it works. But I would say that I think they would get more acceptance if they started out small. I'm not so sure. But what do I know?
I don't know.
In a loft apartment downtown. So I
think that,
I don't know.
It's a nice loft.
It's a nice loft.
No, I think that both things are true. as is with most things in life. I think that they are absolutely going to buy Bitcoin. I believe, like, in a significant way. Market. So I think that is going to happen, and you cannot give me a logical reason why they shouldn't. Now, as far as the other big projects, I don't know if they will buy them as a way to message and say, hey, American crypto is back, because a lot of them have gone down in value and some never recovered. Some legitimate projects that had significant potential were utterly destroyed and their value wiped away because of what the Biden administration did with their choke point 2.0. And so, to me, it's like, I think some of the crypto degenerates are owed a little bit of a attaboy and a little bit of a bump because of how wrongful they were treated. They were treated worst. Okay. Money launderers and terrorists received greater benefit of the doubt than a lot of the crypto bros did from 2021 to 2024.
Well, that's from a regulation standpoint, and it's specifically how the SEC under Gary Gensler looked at crypto holdings in relation to securities and how they define them according to the Securities Acts and things like that, the regulation. And so even amongst themselves, something like Bitcoin or Ethereum would get approved and something like Solana wouldn't. So,
well, they don't even need to do, aside from a Bitcoin reserve, which I think in nations around the world are doing it, and it should be done. I'm never going to change my opinion about that. But having an American crypto index, just simply having the SEC issue friendly notices, regulatory opinions on, say, if it's 50 of them, then the U.S. government doesn't have to buy one of them. BlackRock's going to do it.
Well, there's already fund companies creating these because they know that's going to happen.
And that to me makes more sense
into ETFs
than some bureaucrat trying to say, well, we need Ondo instead of Polkadot. Again, the names, it's so funny. People listen.
Yeah.
But there's legitimate use cases.
Those are not even the worst names.
Yeah. There's legitimate use cases, and I think that it's great for you to have concern over what is objectively positive regulatory momentum moving in the direction of the crypto space rather than what we were living through. Yeah. And so, they'll probably get some things wrong, but I think it's, like you said, sometimes it's good just to shove it down the pipe and see.
And maybe it's getting easier, but maybe the thought here is that these things are typically not the easiest things to go online and purchase anyway. So, maybe what harm is it if you have, again, these are not even really the altcoins in and of themselves that they're talking about, at least the ones he listed in the strategic reserve, are not even the ones that
what's the list? I'm gonna pull it up.
Are concerning. We have to find whatever his tweet or his truth is. And I'm not even saying that those necessarily are concerning, but I think it's,
I was doing things outside yesterday.
Well, congratulations.
So I wasn't paying too much attention. Bitcoin, Ethereum, XRP, Solana, Cardano. It's really no risk names. Wide adoption.
Risk, but
wide, significant.
Outside, yeah.
Yeah, significant adoption. It's not a rug pull. There are people that criticize the decentralization, which just simply means, does any one organization control enough supply to change what would be the best terminology? To change to update the program, to alter and change the supply demand and the immutable characteristics of the tokens.
We'll have to put that on the screen.
Yes, immutable characteristics. There's some questions on some of those, but I think they've all been around a while, and I don't see anything necessarily, wrong with that, but definitely, Bitcoin is going to have significant movement. Bitcoin will, take it to the bank, at some point in time be worth more than $1 million a token. Now, how long will that take? Probably 12 more years, but 8 to 12 more years, but it will happen. So I think it's great for the U.S. And I will disagree with a lot of people out there that think that the U.S. getting into crypto now means that the price is only going to go up from this day forward. And It's not. You're going to have volatility. And if you're the government and you're wanting to build a little stockpile, aren't you probably going to wait?
You like the volatility.
Yeah, you're going to wait.
Same with the oil market.
Yeah, there you go. You're going to wait. But no, that's interesting. It is. I don't know. We'll see. We'll see how it works out. But I think it's good to be having this discussion rather than crypto founders being put in prison.
Yeah, well, I don't think
for
agrees.
ridiculous, just completely. If you weren't paying attention to the crypto space, I would encourage you to spend some time, on Grok or Google or Chat GPT and just start trying to look at Choke Point 2.0. Look at how many people were debanked. Look at how many people caught charges.
Wasn't Melania debanked?
Yeah. Oh, yeah. I was debanked in a much lesser degree. But, I had a Bitcoin mining enterprise and was needing to set up an account, and I was shooed out of the bank.
Well, that has a lot to do with the Bitcoin regulation as well, because
but it was dollars. It was only dealing with dollars with them.
No,
it was
but
just
there's
because
certain.
I used the word Bitcoin to describe the business function.
Well, it's the same thing that people that are in the marijuana trade are dealing with right now.
Well, marijuana is illegal though, and Bitcoin is not.
Well, I mean,
federally illegal marijuana is.
Yeah, but there are certain states that have approved it. So there are certain state banking institutions. Why couldn't you go to a state banking institution that's chartered by the state and be able to bank in whatever state they allow? I mean, you don't have to go to a giant corporate bank. You could go to a local bank. Why can't they? But they don't have the tools because they rely on the giant banks. Your local bank banks with JP Morgan Chase. So, I mean, it's like, what are you going to do? It's wild.
The next bank I learned is that I just broke it down to the what is the business activity. And it's simply setting up compute power for software.
Yeah, well,
just what it is.
You're giving advice, I guess.
Hey, I'm
not
just saying.
Advice.
Just saying that is what it is. Something of those lines, anyway.
Well, we're 40 minutes into it, so let's move on to.
We got to move. We got to move fast.
PCE data last week. PCE data came in 2.5% increase year over year, signaling slight cooling of inflation.
PCE stands for personal consumption expenditures.
Yeah.
So the Fed likes to look at that much more than CPI. Showed a 2.5% increase year over year, signaling slight cooling of inflation. Oh, I'm sorry. I was prepping for the segment.
Yeah, I know.
I wasn't listening. It wasn't. Did you say the next part?
It's almost like we're reading from the same script.
It was in line with expectations. Now, this is interesting. I know you didn't say this. Income was up, but spending was down. And that's a big deal. And I think that is relief for people that thought the Fed may be more hawkish than they have been in recent months. I think that's going to take the pain away from any ability to be hawkish, because you cannot have inflation adjusted income going up and inflation adjusted spending going down.
Yeah,
something is not
well, I think
there.
It's the time of the year that we're in. Again, we talked about this a couple weeks ago. We are in January and February. We just had a giant holiday season. So people are letting off the gas a little bit. Maybe that's the explanation.
No,
Maybe
it wasn't
something
seasonally
else.
adjusted, I don't think.
Because it wasn't seasonally adjusted?
It's the consumer spending went to the lowest point at any time in the last
year over year.
48 months.
Okay, interesting.
And then yes, it's year over year. The last time that income was up and spending was down to this degree was February of 2021. So why is that? Now, you want to point to some type of seasonal thing. Some people would say that was it something to do with the abnormally cold February that
people
we
didn't want to get out. They didn't want to spend money.
Very cold.
Well, now we live in an economy where you don't have to get out. Yeah. You can sit up here and get something delivered from Dollar General.
So I don't know. I mean, it could be it. We had some severe weather, very, very cold in a good part of the country. So that could have impacted it. But if that is not a significant impact, which some people would say that it's not, and that's giving the Fed a signal that rates, that they're being a little slow on the front end of the curve, that rates need to come down a tad bit more. Now, we look at the 10-year Treasury, and it was lower, and Garrett talked about that at the beginning of the podcast. We're now looking at, it has been unable to break 4.5 on a close, I believe, and I could be wrong, but 4.5 or 4.6 for the last 12 months. And we are now going lower and lower on the 10-year yield, which, again, we want to see. Along with that, mortgage rates last week closed out the 6th consecutive decrease for 30 and 15-year mortgage rates. So again, you're either the long end of the curve is going to have to go up, which means people are going to be selling bonds and most likely buying equities. You don't want them selling 30 years and buying, 1 month, but I guess that could happen if they're selling 30 and buying short term.
Short term is still paying.
But something's going to have to give on the front end of that curve. And I'm thinking that, I think what the Fed futures market is saying 2 cuts for the remainder of this year. I think that's probably likely, but I'm thinking they may pull those 2 cuts forward a few months closer to now. I think they may do it sooner than people are expecting, even though we may still in the year at only getting a 50 basis point cut in total. I think they're going to have to bring it forward.
Front load it?
I think they're going to have to.
You still got BIL, which is a short-term treasury ETF, SPDR. Yields almost 5% still.
So it's interesting. And then NVIDIA beat completely on their earnings. Auto segment
still down on the week. Stock
still down on the week. Auto segment doubled. That's a 100% increase in their auto segment. Now, what does that mean? That means the chips they supply to automakers for what? For things such as self-driving or driver assist, if you're a company that's not Tesla. So they...
Man, I saw a review from Car and Driver about saying that GE's...
GM?
Not even... GM, they're not even... They're self-driving.
Both irrelevant companies at this point.
This is also getting way out of... this is a tangent, but the GM, that their like autopilot feature, because they don't even have the full self-driving, is better than Tesla's. And I don't have a GM vehicle, so I can't test it out myself, but I would be highly surprised if that's the case. But you have these analysts coming in, just got a notification like a few minutes ago saying that Morgan Stanley has increased their target price points, for Tesla, because they are understanding that the lower delivery estimates are just par for the course for a company who is focused on AI and technology rather than selling cars. And so you're going to see this shift. And this is what we've talked about, which is that Tesla as a stock, as a company, is not a car company. And so I don't know how much longer you're going to see them miss delivery dates and still get hammered on the stock. I mean, is that just going to be baked into the pie from now on? Is that Tesla, if they sell cars, that's great, but really what we're looking at is the full self-driving network, the charging infrastructure, the things that they're sort of laying out.
My head hurts.
Especially when it starts getting adopted by other companies. What if 2 or 3 years down the road, we should bookmark this, because if 2 or 3 years down the road,
you can take it to the bank.
2 or 3 years down the road, you get into a Ford F-150, and there's Tesla AI powering the self-driving of it.
Yeah, and people may be like, "Well, I don't know about that." Well, why does Bosch, who makes industrial equipment, power tools, and dishwashers, why does the Ford F-150 rely on Bosch systems to operate? Which it does. So don't just assume.
Why does a tire company rate restaurants?
There stranger things have happened. I mean, it hurts my head. If you ever listen to an analyst to decide to get into the market, you're never going to make any money. You're not, because if they were right, they wouldn't be on CNBC making $180,000 a year to give you their piece of advice. They would be trading on it, and they would be filthy rich. So just use common sense and take what these people say with a grain of salt. Yeah, Morgan Stanley's coming and telling you that it may not be just a car company. Listen, I own a Tesla. That's what I'm saying. We both own Teslas. Recent Tesla buyers here, and I never park next to someone and they say, "Oh, that's a nice car." No, what happens is when I walk out of the grocery store, like I did yesterday at Kroger, and I press the button on my phone to make the car come to me. My dog is sitting in the car, because there's a dog mode, right? My dog is sitting in the driver's seat of the car, and it's driving itself to me. And anytime I do that, which I generally try to do it once or twice a week because I just love the reactions, I get people that like are frozen, like they're like they've seen a ghost, and they're looking. So this one lady, I'm pressing the button, the car comes to me, parks, and I go to put the groceries in the trunk, and the woman is just like frozen there. And I said, what's wrong? You've never seen a dog drive a car? And she didn't have words. she was like, does that car drive itself? I was like, it's pretty cool, isn't it?
Is this like a well-known thing at this point?
I don't think that it is. No,
really?
This happens to me every single week. I
would use the feature one time. I don't generally don't use
It's unbelievable.
That.
I mean, we were at the Kia plant.
I think if they figured out a way to implement it in a way that I didn't have to stand there and hold my finger on a button, maybe it would be less awkward for me to do. Maybe I would use it more, but I don't want to go through all
right
that.
now it's there for safety because you have the cameras presented to you on the app to know that.
Yeah, but that goes against their whole claim that these are safer.
I know, but I think that's one thing they have to do, just like they have to nag.
Yeah, that is annoying.
Yeah, even though that doesn't really have to do it. It's safer to not
this goes to the whole point.
You.
And these videos just turn into Tesla talks for some reason, and I don't want to keep doing that. But
I think it's imagine if you were in 2010 and we were talking about the technology, because that's really what drives investing. Well,
2010, the iPhone had been out for 3 years.
Are there magnets on these computers?
Probably.
I think the fact is technology drives innovation. Innovation affects people's lives, and that can give people a high degree or a lesser degree of confidence to invest.
Well, anything that helps people drive better, I'm generally for. But I understand the nagging part of it is them trying to get the software right, because I think that at some point this year, maybe it's December 31st, 2025, they will announce the unsupervised full self-driving, and that software will be available because they're already going to test these robo-taxis or robo-cab or cyber-cab or whatever they're calling them. They're going to test them in like parts of Texas and parts of California. They're going to get approval for all this stuff. And so those don't even have steering wheels or pedals. I mean, this is effectively an Uber that you get into and it just drives you wherever there's no way. I mean, ostensibly, maybe there's an override or maybe you can access a customer service rep on the screen or something, but they have to get that good. And so they have to have a starting point for that. But I think it's pretty good. I think it probably is 1 step, 2 steps maybe away from being able to pull that trigger.
Yeah, and it's just, it's not, we're talking about things that are a little more interesting to the average person when we speak about iPhones or Teslas or things going on in the crypto market. But it does, it's good to look at things like that because it shows you how much growth and how much potential there is in all parts of the market, not just dealing with one particular name like an NVIDIA or a Tesla or an AMD, but it does, when you start paying attention to the things that are going on around you, you can start being a lot more optimistic about the future versus when you're listening to news organizations that would always have you believe the top is in, depression's coming, sell, because you don't make any money that way. You just don't. You can, the bears and people that short the market generally always sound much smarter than any other bull or somebody that's optimistic about the market, but they're generally wrong like 95% of the time. And so, it's good to look at these things because if you're on the sidelines or if you're wanting to improve your investment portfolio, you can't do it from a position of pessimism. You have to be optimistic and get a process that works and understand that, there's a significant amount of change that's happening in our lifetimes. And when change happens and when innovation occurs, that's when you make money. And that's good, generally regarded as a good thing. But let's speed through here real quick. So we have manufacturing PMI tomorrow. That'll give us another look at the health of the manufacturing sector, which goes right into your next point about Trump speaking to Congress. Look for discussions on tariffs because we may see PMI pump up in expectation of tariffs buying, but I mean, they don't have much time. So maybe in the last month they did. Target and Best Buy is going to report earnings. Target's always a good indicator of consumer spending. We have
certainly is for my household.
We have national employment, ADP. That's the private sector report, which has been more accurate, but it gets less weight in the news cycle. The beige book, I don't really pay attention to that. It's kind of boring. The monetary policy announcement about the Europeans, is what it is. You got Macy's, Kroger, Costco, Gap, Burlington stores. That'll also give you insight into the health of the consumer. And unemployment rate on Friday.
Payrolls.
Yeah. So, I would just say that expect probably continued volatility that's kind of outside the norm, especially with tariffs going in tomorrow, it appears. Pay close attention, but, don't make your investment decisions based upon these key things. It's good to pay attention to it, though, and speaking a different language, and to use it to gain a better understanding of why you're investing and why you're just not saving in dollars, why you're maxing out your 401k, why you're investing some in your brokerage account. And then if you need help, reach out to a financial advisor that you trust, momentumwealth.us. Be more than happy to talk to you. And, you know, just chill sometimes. Take a chill pill. And we've already seen, look, if somebody was running around crazy last week saying Bitcoin's going down, they woke up today and it's up $14,000 from the close on Friday. So just chill. Take a deep breath.
Some news cycles that go into that as well. But yeah, that's a good little wrap up.
And I'll say one more thing.
Sure.
Because you said it the other day, we were talking.
Permission to say it, permission to speak.
When you were saying, you know, we do this thought experiment a lot because unfortunately, a lot of the millennial generation was not of working age or did not have the means when the tech crash occurred and kind of a whole new base of support was built for companies like Amazon and Apple in the early 2000s, 2002, 2003, 2004. So you're looking at, you know, well, what if you had listened and understood the change that was happening, paid close attention to it, and adjusted your investment portfolio and investment strategy accordingly, you know, even just not necessarily going into those names, but just paying attention to what was happening in the NASDAQ, allocating money to the S&P, not trying to be more conservative than was necessary in your investment approach. Just the innovation that took place in those few companies from 2004 to 2015 doubled and tripled those indexes. They carried the weight of the market, basically. And these changes and innovation that's occurring, I'm going to tell you is going to happen again over the next 10 to 20 years. So that's why you got to pay attention to what's happening and not be scared off a good investment strategy and work with people that understand what's going on and that aren't, you know, easily intimidated by changes in the market.
Well, a lot of people don't really pay attention to it very often. And so they just have, you know, sort of cursory knowledge or sort of knowledge that they hear about in public of, oh, my friend is losing so much money in the stock market, or, oh, you know, I see the headlines on the news and stock market's going down, or whatever it is. And so a lot of times those people would benefit from having somebody to come alongside them and help create a strategy that you feel comfortable with. Because if your strategy is a good strategy, it's not going to change because the market was down 2% this week and up 2% last week. It doesn't change. Yep. It doesn't move the needle at all. But what does is, you know, making sure that you are steadily working toward the goal, whatever your goal might be. If your goal is early retirement, if your goal is a retirement at normal age, if your goal is late retirement, whatever your goal is,
and the strategy may not always be max allocation to equities to get the most potential growth. Right. Because if you're in retirement and taking income, the strategy is, listen, if we can target 9% and that's that works great for you and that's more than what you need, then why risk trying to go to 20 and live through those ups and downs while we're trying to generate income for retirement? So the strategy isn't always, you know, pedal to the floor, max allocation all the time.
Right. The strategy is different for everyone.
That's right. It's finding a good strategy.
And it's even different among age brackets. You know, we've met 80-year-olds with a very high risk tolerance.
Oh, sure.
And we've met 30-year-olds with a no risk tolerance at all. I mean, they're terrified. And so the way you have to do that is sort of work with those strengths that those people have, and sort of get them in a place where they feel comfortable. That's the most important part. And then over time, you feel more and more comfortable and you're able to understand, and you have people that are there on your side watching it for you and explaining things to you. So that's just how it works. It's not a quick thing. It's a process, but the hardest part is to get started. So that's what I would say. I think that's probably a good place to end it. Next week, we're going to look into the jobs numbers that came out for March. We have more decisions from the Federal Reserve, and then continuing into earnings season. I saw that you took my cup. All right. Anyway, if nothing else for you, thanks for tuning in to Momentum Mondays today. If you're watching this video, feel free to like, subscribe, share.
And I think we're going to have more videos coming during the week. Maybe.
I don't know. Can't speak to that.
Maybe.
That's in your wheelhouse.
They'd be short, though. Very short. Like me.
I think that's okay.
Short. It's okay.
There's a room for all of it.
Yeah.
Anyway, we'll see you guys next time. Have a good one.
Take care.